Hi, I'm Roger from Plan. Welcome. I'm sitting with my colleague, Griffen Fry. He's one of our developers, and he's the guy who did the bulk of the heavy lifting, well, all of the heavy lifting on our efforts to get all 43 states plus the District of Columbia into scenario analysis. And we've now reached that point where they're all in there. We're still in beta, but really, I think we have a working model that we're proud of and we think is ready to release to the world. Griffen, we'll have to talk about the District of Columbia before this is over. It's
Okay.
become a bit of a joke internally for us. Um, so, Griffen, let me make sure people know some of your background. You're one of our developers, like I said. As far as I know, you grew up in Texas, right? Which is where I'm located as well. And you attended Texas A&M University, Corps of Cadets, which is a thing that Texans would know what that is, but others may not. But it's a part of the Texas A&M experience, and studied physics. And my one question to you, which I asked earlier, was which is less intuitive, quantum mechanics or state taxes? And I think you said state taxes, which is
hmm
not surprising, sadly, but it's a sad statement of our affairs here in the United States. But yes, quantum physics versus state taxes. Go with quantum physics if you want something more understandable. Um, let's see. So we were going the purpose of this call is just to go a little bit more into detail for the nerds out there who really want to kind of dig in on state taxes, maybe hear about some of the commonalities, but also some of the quirks that we encountered as we were building this functionality out, because there's really nothing that gets you deeper into the weeds than having to code this stuff up and back test it against existing returns and all that stuff. You really learn some of the quirks of how these work. So maybe we start with, and I'd like to get to some of the goofy outliers, but I'd like to start with some of the commonalities. So like when you're looking at, and I know there's a lot of exceptions to this, but if you're looking at the general structure of state tax returns versus the federal, what sort of patterns did you see? What are some commonalities that occurred there?
Yeah. So every state will be different. We'll have different uh, iterations of it, but generally, most states will say, well, we want to start with some kind of taxable income. We've got the federal AGI from the federal return. So rather than have the federal return will take in a whole bunch of information to get to your federal AGI, we say we'll just take that, and then the state will just make adjustments to it. So we'll do some additions, do some subtractions. Maybe it won't have its own state AGI. From there, it'll take a standard, maybe an itemized deduction, maybe it won't have an itemized deduction. Uh, Come to a tax liability, run it through a tax bracket, apply any from maybe two credits that exist to a whole two schedules of credits that you could apply
Mhm.
to just arrive to a tax due. And I mean, not very few states are going to actually go by that uh, structure exactly, but generally they try to kind of template off of the federal return in that sense.
Yeah, I mean, if you were to take the most basic version of state taxes, which I guess almost no states actually follow, we would have built a screen that would just like start with the federal AGI, add your additions, and we'll talk about what additions and subtractions mean, but additions to adjust the AGI up, subtractions to adjust it down, maybe a line on itemized deduction uh, uh, changes, and then that's it, and then you're done. The reality is, it seems to be that every state it's a little more complicated than this, just that, sadly. I mean, I kind of went into this project thinking in the beginning that's all we would need is just a few fields, five tops. I was so naive, Griffen. Five five fields tops were just like addition, subtractions, and then adjustments to um, deductions, and then you're done. As I got into it, and I know you got into it a lot deeper, it was evident to me that there were some real design decisions that kind of go into a lot of each of these states. So, for example, additions and subtractions. Um, when is a good case for us to calculate that versus ask the advisor to enter it? And An example I remember coming up with some frequency was something around Social Security, where sometimes it was taxed differently at the state level. But we know the Social Security, right? We know that. And so we could make the adjustment on our side and not ask the advisor to make that adjustment in a spreadsheet and then enter it. And so that was a good example I thought of where it made sense for us to split that out from additions and subtractions. There were also, but there were other things that we just didn't know, like the Hawaiian exceptional trees credit or whatever it is. Like we don't, that's nowhere on the federal side. So that the advisor has to enter that themselves. I love that example of the exceptional trees credit in Hawaii. Um, Another design thing that came up was when do we, when is something so basic or rather so critical to the planning process that it's worth splitting out. And so a great example is the 529 contribution. Like we know that's a thing that financial planners are using as a tool on the financial planning side. And so rather than have them enter that in the subtractions field or maybe the credits field, I guess it kind of depends what
Depends
the
on the state.
situation. Okay, yeah. All right. Rather than have them have to know and enter it in there, we give them a box that says 529s and then we treat it accordingly. And so as we went through each state, that was the sort of decision making that had to happen. There was design, there's just learning the rules about how this stuff works. But then what I always stress to people about it, like the rules are open source. They may be poorly worded and poorly, hard to find, but that is open source. Like that's the law. Whereas the hard part for us is the design side of things. Which fields do I show? Which fields are so obscure that we're not going to show them? That's the harder part about what we do at the federal level and now the state level. What are some I mentioned a few examples of additions and subtractions, but what are some other examples that you encountered of additions and subtractions that you saw show up in multiple states?
Yeah, so as you mentioned, the 529 contributions tend to be subtracted. Non-qualified 529 distributions tend to be additions in a lot of states.
Mm-hmm.
Some other additions would be like a out-of-state municipal bond interests. So if I'm in Arizona, I've got California bonds.
Sure.
Usually Arizona wants to tax those, not their own, but out of state to kind of encourage you to buy those in-state. 179 depreciation expense. Sometimes like parts of it will get added back, some of it will get subtracted. Net operating loss carryover tends to get added back. Lump sum distributions. I'd say those are the biggest five.
There were several states that have stuff around pensions and retirement distributions as
Yeah,
well.
so subtractions, there's definitely a lot more subtractions than there are additions. So Social Security, that gets taxed federally or just all the benefits. Sometimes it's, hey, whatever they taxed federally, just subtract it out at the state level. Don't worry about it. Some states will give you entire worksheets. Some just say, nope, just don't do anything with it.
Mm-hmm.
A lot of military pay, National Guard pay, military retirement income gets subtracted out. Some states will do MSA, HSA. I've seen a lot of organ donor expenses as a subtraction, which I think is interesting. But that kind of comes into like, it's so obscure. Why would we don't really need to break that out because.
Yeah. Do you make a field for that versus
Yeah.
ask that's a great example. Do you ask the advisor to just know that and enter it, or do you make a field for it? Yeah.
Right. And yeah, one of the biggest things, and one of the things I'm looking at here in the future is the IRA, pensions and all of that, how that gets subtracted out, because the issue with that is a lot of it gets done, look at each spouse separately in order to make a proper subtraction. So one of my next upcoming problems is how do we get that information on a spousal level from the combined federal value,
Right.
so that we can do more of the heavy lifting for the user, and they don't have to keep track of everything themselves.
Right. So yeah, great point. So this is another one of these design things that came up at the federal level. So people watching this who are used to using scenario analysis at the federal level, they know that we start with last year's tax return, we copy it forward, and that can be your basis for creating a scenario for the future, which is a great time-saving device. I can assure you, in my previous job as an advisor, keying all that into other products was an enormously tedious and error-prone process. The difficulty we run into is the federal return doesn't split out some of these things by spouse, We encountered that at the federal level, actually, with wages with respect to the dependent care credit. But it comes up at the state level a number of times where you have each spouse is what, first 25,000 or 50,000, it depends on the state.
Depends on the state.
The first X amount of their retirement distributions are tax free at the state level. And by just pulling over federal information, we don't get that breakout. And so now we have a design decision like, do we need to break it out by spouse? And if so, we probably need to have that bubble back up to the federal data entry form. These are just the fun things we do when you add functionality to a software. Yeah. Any other how about some goofy outlier subtractions you saw or additions you saw?
I've got some favorites. I know you mentioned the exceptional tree deduction in Hawaii. Arizona has the deduction for conversions of wood-fired stoves, ovens, and fireplaces. Connecticut has the deduction for
conversions to what? What are you converting them to?
I think it's a conversion of a wood-fired stove to like a gas-fired stove.
Oh, okay. Yeah.
Or it's the other way around.
Actually,
I can't tell you, that was months ago.
What's the policy choice we want in that case?
It has to be qualified. And I don't know what deems it to be qualified, but
got it.
There's a lot of weird. My other favorite is the Connecticut's deduction for repairs made to concrete, which was deteriorated due to a certain mineral that was in a lot of concrete in the area because of a quarry. But basically the mineral would expand when exposed to moisture, and it cracked all these foundations. And so there was this whole mess of houses just foreclosing. It's like, wow, now we've got $100,000 of foundation damage.
Oh, wow.
And the government said tax deduction, I guess. That's
your physics training came in handy there. That was some thermodynamic stuff happening right there. Good.
But yeah.
Okay. How about well, we're talking about additions and subtractions. We might as well talk about adjustments to deductions, itemized deductions. That was also a thing. I found that actually to be pretty challenging on the coding side. It was more obscure and maybe harder. I don't know. The documentation was maybe not as good. What were some examples you saw, both common and exceptional, on the adjustments to deductions piece of things?
Well, one of the most interesting and I guess foundational parts of the whole aspect is not every state even has an itemized deduction. Also, the rules of taking the itemized deduction depends on the state, even if they do have it. So some states are like, if you took the itemized deduction federally, you have to take it at the state.
Right.
Some are, if you took it at the federal level, you can take it at the state level, or you can take the standard.
Right. Which creates some strategy. Like we've definitely seen people itemize at the federal level, even though it was lower because they were taking it at the state level, right? That's a thing that comes up for sure. But you're saying some states, you have the choice.
Yeah, right. Or if you take the standard deduction federally, you don't have the choice to take their itemized deduction. You have to take the standard.
Yeah.
Whereas you would have the choice if you itemized federally. And then some states just say, regardless of what you did federally, do whatever you want at the state level. The common theme is it just depends on the state. More granularly, if you look into a lot of the itemized deductions, those are much more templated off of the federal Schedule A. A lot of them will then tweak it over time. So a lot of them still have like deduction subject to the 2% floor that was removed a while ago. But they said we're actually going to keep, maybe not all of them, but some of them. So we have to, now we have to keep track of those again. Some states
also the state and local tax.
Salt taxes.
Federal level.
So salt taxes get adjusted a lot. Some of them will say you can subtract everything else, but not the actual state and local tax. But like, personal property, real estate tax, we'll keep working with those. Now, how they handle that cap, again, depends on the state. So some of them will just say, okay, well, now we're going to use the same 10,000 married filing jointly, 5,000 married filing separate cap, except it's just on the real estate and the personal property tax. Other states will say, use exactly what you used on the federal Schedule A, except like pro rata, subtract out your state and local income tax. So it's general, those same three items in the SALT, but how they handle it is usually very different.
Wow.
I'd say that's one of the bigger changes across all of the states.
Did I see how about medical deduction? Did I see somewhere that some states don't have the AGI floor, or is the AGI floor different for medical? What did you come across there?
Whenever I come across it, um, they usually keep the AGI floor.
Oh, okay.
Some of them make changes along with the federal return, some don't. So it's always, I have to double check, like, is it 7.5? Is it 10%?
Oh my gosh,
Got to make
yes.
sure. And then, some of them they'll change it, but they'll change it later than the federal return. So like it doesn't always line up. So it's sometimes it's 7.5, sometimes it's 10, but I still have to make sure that I'm looking at what year the scenario is to make sure
Oh,
I'm pulling that correct percentage.
got
It's
it.
it's wild.
All right. Well, so we talked about additions and subtractions, which are nutty and crazy. But there are even some more foundational differences. The one that's come up a few times is filing status. We should talk about that one, but if you have any others, I'd be interested in hearing those too. But let's start with filing status. At the federal level, I've got single, I've got married filing jointly, I've got head of household, married separate, and qualifying widow or widower. But states got some states, like I think Missouri is one we've encountered, have different filing statuses potentially, right?
So yeah, some states will have less than those five, and they'll say, okay, well, if you were head of household federally, just call it single or call it married filing jointly at the state level. Some states will say, whatever your married filing status, whether it was joint or separate federally, you still file married at the state, but you can switch it up. So you can do joint federally and separate at the state level, or vice
Mm-hmm.
versa. Some states will just say, no, whatever you did federally, you're doing it at the state level. But then, like you said, Missouri, some will have more than those five, and they'll add this. What's come up in 8 states is this married filing separate combined, and that gets really tricky for me trying to do this from a federal return, because what they'll do is they'll say, okay, we're going to put both spouses on the same return, but they're both going to be in separate columns, which means
I
we're going to
see.
break out every single one of these, things that we talked about, out of state muni interest, 529 contributions. We're going to do each spouse. And that
Mm.
includes, the starting point, the federal AGI, any wages and all of that.
It's really two tax returns on one form,
mhm.
right? Yeah.
So I've managed to work on approximating all of that, where I will look at actual returns where they have these things broken out, and I say, okay, well, if I'm just combining these, how correct can we make this? And we can actually get it pretty correct if what you put in the box is the combined values. The
Yeah.
issue comes in where we have taxable income, and then you run it through the tax brackets. The advantage of doing this married filing separate combined is that both spouses can hit those lower brackets. Whereas if you do it jointly, one spouse can hit the lower brackets, the other is just sitting on top the whole time.
Right.
So that gets a little bit off. And that's another one of those things where we are working on a way to, how do we handle this and get both spouses in a way that's doesn't become a huge burden for the user.
Mm-hmm.
Uh, it allows us to give a more accurate output for them in those weird edge cases.
Any other weird? I mean, let's get to the weird stuff now. So, what are some other kind of funky things that you remember, outliers wise?
Yeah. So one of the biggest ones is, so oddly, it's an outlier because it does template the federal return is only 5 of the 44 state income taxes, well, 43 plus DC, have AMT.
Mm-hmm.
Which you think would
California's
be
one. What?
more. So
Colorado,
California,
Minnesota.
Colorado, Connecticut, Iowa, and Minnesota.
Mm-hmm.
And some of those are very like Colorado's very easy. California's very difficult.
Of course.
Like California was, I almost doubled the size of the code base just to build
Yeah.
that. It just, like I said, it just depends on the state.
Yep.
A lot of those, they do pull a lot of the information from the federal 6251, but
Mm-hmm.
then they'll make their own adjustments.
Sure.
And what do we want to prioritize for our own state's policy? Other weird things is states with just ridiculous complexity added to things. I'm sure it makes sense in some way to their legislation, but California's, if you live in California and you're used to those adjustments and that's all you know, please look at other states and see just how hard it is, because there's so many rules and adjustments that you can make that they say, okay, here's some of the generic on the instructions, but here's some of the generic, but make sure that you're looking at the law to see what the differences are and accounting for, each line that you would have on like a federal term now make the appropriate additions and subtractions to this value. Like you could have both, just changing on the line. They're like, there's too many for us to track in this 100-page instruction manual. So
Yeah.
good luck.
And
That's
so in
pretty,
those cases, I mean, really, we do our best to guide the advisor. I know you've valiantly tried to add some little hints about here's what we saw, here's how you feel in this field, but really the advisor is going to need to know their state and their client situation.
yeah.
And then also know when to throw their hands up and say, I need to work with a CPA on this. I'm nervous about someone sitting down with a state. Let's say I'm based in Texas and most of my clients were in Texas, but I did have a couple in California. And in hindsight, had I tried to run some of these projections for them in California, I would have been in way over my head and potentially would have done something dangerous, no matter how great the software is or how much the software coached me, because some of these obscure adjustments were in there, So word of warning to advisors watching this, know your limitations. The software, we do our best to get you there, but you're going to have to know what's going on behind the scenes on some of these adjustments. Otherwise, it could impact the numbers you're giving to your client and just not be right at all.
Yeah. And fortunately, a lot of these pieces are very rare.
Right. Yeah.
But
Obscure. Yeah.
they do occur. That's, that's why they're there. Fortunately, every state is at a point where you can get the calculation exactly right with the proper inputs. It's just a matter of some states have a lot to keep track of relative to others.
And we should say, that was your method for testing the code. Is that fortunately for us, we have many tax returns in our database, so we were able to pull a whole list of ones from California and then run the code against those. And so that I'm sure helped immensely, rather than trying to just go purely off of their instructions or the laws themselves. We had real returns to check against.
Absolutely. And I can see how those returns, when they're scanned in, now what values do I have to work with and how can I make those work with the user input? So really for me, every state became a problem of how do I reduce the number of inputs that the user has to give us while giving us the most accurate calculation we can.
Yeah.
So now, I mean, states can be within cents of a accuracy with 3 inputs for most users, whereas a good number, no inputs required, especially if it's a simpler situation. But that's always been the problem. And then a few other weird outliers that have made that a bit difficult. New York's tax calculation has it's pretty straightforward. It's pretty standard. They've got additions, subtractions, deductions, but then their tax calculation, like their tax brackets, it's not as straightforward. Run it through the bracket. It's okay, but if you're in these weird,
they have 2 methods,
AGIs,
right? Yeah.
If your AGI is within this range, your taxable income's within this range, now use this worksheet. And so there's 3 or 4 worksheets depending on your filing status that you could fall into. They alter how you get taxed, but they never explain what it's doing. They just say use it.
Right.
So I spent, almost 2 days just literally building these calculations and then just graphing them for every AGI and taxable income with up to millions of dollars, just to visually see what is going on here, to figure out why. Mostly because in 2021 the brackets change and I needed to re-extrapolate these worksheets to account for the new brackets.
Right.
So I really had to understand how those worksheets were made in order to rebuild them for 2021, because they haven't been released yet.
Yeah.
Turns out if your New York AGI goes up, you're not able to deduct yourself back down into a lower bracket, was the whole point of things. But
I see.
Just weird complexity. The other difficult tax was Connecticut, because they've that line on the main form where they say, okay, here's your taxable income, now calculate your tax. It looks really inconspicuous, but then when you go to the instructions, it's 5 different tables, some of which are like personal exemptions, there, some are personal exemptions, some are personal credits. There's a 3% tax add back phase out along with the tax liability, and then another piece. It gets rough really quick, but with enough work, you can unpack it all, figure it out, and make the system do it for the advisors so they don't have to go through that. But some
There were
states
some
just,
other outliers. So like Tennessee, I know is an outlier. Their deal is what? They only tax you on investment income. Was that their story? Or
yeah, so Tennessee and New Hampshire both go, they have a different complexity in the opposite end of the spectrum where they're like, okay, we're just gonna tax, yeah, some dividends, some interest, but like not wages. We're not gonna worry about that. Um, Run it through a very basic calculation, very minimal adjustments to make. Pretty much they just say, just here's a standard deduction. There's no itemized deduction. Very straightforward. But it's, again, it's not always information that we have,
Hmm,
which is frustrating when it's like a 5-line return and it's like, wow, we don't have
brutal.
all of this. So there's still some user input, but yeah, they don't all follow that same structure of the
Yeah.
federal return.
What were the best states? Who are the easiest states that we should hold up as the example to emulate?
Um, so ironically, it's not Tennessee or New Hampshire because it's now I have to make a whole new structure for something.
Hmm.
What made a state really easy for me as a programmer was what states follow the same order of operations, whereas a pretty cut and dry, use the same tools. Uh, I'd say Georgia was one of them, Kansas, Idaho. Honestly, it's hard to remember them because I spent less time on them, but there was, I mean, more than half were pretty straightforward.
Really?
Colorado's, even though it has AMT, is pretty straightforward. Wisconsin,
Wisconsin, that was one I thought I worked on. And I think Wisconsin's where I started to give up on the project. And then I turned it over to you.
it does have
Virginia
a
wasn't too
weird,
bad, I don't think.
I'm
No.
actually, I'm looking over that next week.
Yeah. Poor
Tools.
Griffin had to not only code the states, but fix all my code on some of the states as well. Um, and so what were the worst ones? Was it New Jersey where you pretty much have to start from scratch? You don't start. Which states do you not start with the federal AGI and you kind of have to build the whole tax return from scratch?
I don't think I have a list on me, but I know New Jersey's one of them, Iowa. Um, there's more. There's states that I try to forget because they're difficult. Um, but yeah, so they'll say, we're not going to start with the federal AGI. We're going to recalculate our taxable income. So they'll pull wages, dividends, whatnot in a completely different manner than the federal return. Um, a lot of the time, the solution that I had for that was sometimes I can get this information exactly correct. So I'll pull that and then say, if you have something different, by all means, override this and use that instead.
Mm,
Um, try to save you some time and effort, but New Jersey is definitely one of those states where I'm like, wow, this is rough. Iowa, I think, is one of them as well. Um, yeah, when they start on their own thing,
yeah.
it's a pain.
Like who are they trying to be? You know what I mean?
They're trying to be their own federal government.
Yeah. Um, so I'll talk about the DC thing in a second, but this is like my last question is if you were to do this all over again, or if you, let's say you're an advisor, like the example I gave, I'm an advisor sitting in Texas and I have a client who moved to California, or it's a family member of a client, or for whatever reason, I need to get up to speed on California taxes and how they work. Now, I know this is the perspective of a developer who I'm going to get this answer, but how did you go about researching and getting to know the rules of the state? What was worth knowing about? What was something that was kind of obscure and we're just going to put that to one side? What were the best tools that you found as you went through that?
Honestly, the best starting point is just the form itself and the instruction booklets that are offered online.
Yep.
Uh, so before I do anything in an actual programming language, I do everything in Excel, where I'll say, okay, this line, this is what I pull, this is how I calculate on it. And I would look at that and I'd build that Excel sheet out just looking at these instruction booklets. Some example returns definitely help, but the instructions, while they may not have every piece of information, especially California adjustments, they do have most of what you need. So if you have, specifically if you have like a client, like you said, is moved out to California, you might think, okay, well, I know what their situation is. I'm going to be looking for specific things, be looking at, how do they handle 529s? How do they handle, my Texas municipal bonds?
Just
So as you
Googling
look
the
through the
brackets, that's the
instructions,
thing you'll do, yeah.
and yeah, those instructions are going to give you, like, oh, on this line of the outstate municipal bonds, then like, oh, I should probably especially pay attention to this line, or I should, if I'm looking through the actual form itself, kind of make a note of, oh, well, my client, may take interest in this specific piece. I should probably look deeper into the instructions to exactly see what's going on with that. And you can get a very, very good view just from that. And then you can just kind of pick and choose what you want to deep dive on.
Yeah.
From there.
I think it's a useful distinction that we as developers, and then also I think financial planners, how we approach it versus say like a tax lawyer or even some CPAs, where a tax lawyer or CPA, they may start with the Internal Revenue Code or the legislation itself and work their way down. They start there from first principles and work their way down to, okay, what is the planning approach to this? Whereas we have generally started with the forms, because the form is a distillation of those rules down to the actual math. And so in general, this is my process too, is we start with the forms. That gives you a good idea of at least what the designers of the forums thought was important to capture. Then you move up a level. If there's something you don't understand, you look at the instructions for those forms. Then on rare occasions, we sometimes go all the way up to the actual law itself to really explain what's happening with this terminology, this thing. But that's a very good example of how our approach might be different from that of, say, certainly a tax lawyer or even some CPAs who, again, are starting from first principles. So, yeah, I mean, it's not a small job to try to do that. So kudos to you. It's a heroic effort to have done that for 43 states plus DC. So we'll talk about DC, which the joke around the office is like, I never shut up about DC. Like, I mean, of all the, like, Griffen would be like, yeah, I just finished Iowa and Nebraska and Minnesota. I'm like, I don't care. Tell me how you're doing on Washington, D.C. That was, and so the reason for that is I was born in Washington, D.C. And I remember in my early 20s, I was doing a lot of travel for work and life, and I was filling out visa applications, and some of those were online. And I just remember filling out forms, including online forms, where like this is early internet days, right? And so you'd open a drop down for what state you were born in, and DC wasn't on there. And it was just like, it drove me up the wall that like, here is this place that is a part of the United States that was just treated like it wasn't part of the United States. So this was me throwing my weight around, and I pushed Griffen to get DC in there. He finally did it pretty early just to get me to shut up about it. But yeah, I was saying to one of our colleagues, Griffen, yesterday, I did this other video introducing the state tax stuff. And I think I said the word District of Columbia like 6 times, and maybe California like once, but that was it. Because I kept saying the 43 states plus the District of Columbia. So like, people are going to think we're super District of Columbia centric, and maybe we are a little bit. So apologies for that, but that's the story. That's where that comes from. That was one of my own eccentricities there. Any final thoughts on the state tax project? I mean, what do we still have to do? You mentioned, let's finish with that. So you mentioned like Missouri, some work we can do. We still get from time to time suggestions from advisors, a lot of times along the lines of, hey, where do I enter this thing? This is something that you should have a field for or not, or this calculation that wasn't how I expected. What's left to do besides just keeping up with this thing year after year? But what's left to do on your to-do list with states?
Yeah, so definitely the married filing separate combined handling is pretty high on the priority, even though it's going to be quite a task just from an architecture standpoint. Other things would be just the breaking out of IRA distributions, because that's on a spousal level for states that don't have this weird filing status. Those
Mhm.
those are actually two projects that are going to go hand in hand
Right.
because they're going to be pretty much handled the same way. Some other things, I want to make a better hint system where it's going to be much easier to update. So if advisors are emailing us saying, hey, what's going on in this box, we can answer that. Not only do we want to answer it for that advisor, I'm sure they're not the only person who's wondered. So, can we better make the
Mm.
interface more intuitive? Can we make better hints? So making that interface easier to work with so they can be updated quickly, efficiently,
Mhm.
but as accurately as possible.
Yep.
Um, that's a big hit on my to-do list. I mean, there's a whole laundry list, but I think those are the two biggest priorities: getting that married filing separate combined accuracy, the IRA breakout, and the hints to be more ideal.
Yeah. Yeah, I think that IRA breakout is particularly critical because it drives an actual planning strategy in these states where if I'm in New York is one of them, right? New York and Colorado are examples. Am I right about that?
At least Colorado, New York probably.
So I think New York was one of them, but like your first, if I want to take $50,000 out of retirement, uh, the advisor should know that it's worthwhile to take 25 out of one client and 25 out of the other client. And so because that's like a very common strategy, it's one of the most common things people brought up with me when we were collecting our list of state hints. We need a way to be able to show that. And right now, I guess the way the advisor would capture that is they have to enter that in as a generic subtraction, right? And kind of
Hmm.
they have to do the math themselves to pull it out. And this is a good example of because it's such a critical and common planning strategy, we should give them the ability to just enter the amounts and then we calculate that subtraction for them. It's a good example. Well, good, man. Well, I mean, I'm sure there's a bunch of other goofy edge cases, not just wood burning stoves and exceptional trees, but that will be for another time. So, Griffen, I really appreciate your work on this. It's just been incredible to watch your progress on this, doing multiple states a week, just racing to the finish. It's truly a heroic effort. So I am truly grateful for the work you've done, and I think that work is going to help a lot of advisors, but ultimately their clients get better planning. I mean, that's our mission: is richer planning to more clients, and especially in some states like California, tax planning must include state tax planning. And
Yeah.
so you have your efforts will make real impact on people's lives. So thank you for that. Yeah, so take a look at state tax. It's in beta. So what you have to do is go to the My Account page, and you can opt into that beta, and you will see a new section in scenario analysis with all these fields. And you'll be able to choose which state. You'll be able to. We didn't talk about range calc, but also when you run range calc, you'll be able to see the state income tax impact there as well. So give it a look. Tell us what you think, and we hope to keep working through it and improving it, like Griffen was talking about. Thanks, Griffen.
Thank you.